Good morning, everyone. This is Mortgage Pros 411. I'm Audery Boyce-Noe with Kevin Casey, and today we are joined by Paul Hindman. Good morning, Paul. How are you?
Okay, so one correction. I always have to do this. It's Hindman, and
Hindman. Shit.
yeah,
Fine.
yeah,
Well,
Okay.
that's a good way to start. Good for me.
yeah.
Hey.
No, no, no worries.
And here we have Paul Hindman,
Yeah,
as in
I answered in anything.
Hindin, but Hindman instead.
There you go. Yeah, all good.
Okay, so where I want to start, well, we always start with what's coming up this week, which is tomorrow we have ADP because it is jobs week. Today we had JOLTS. And Friday we have our favorite BLS jobs report. And who knows what the hell will happen? It could be anything, as we know. So, what I want to start with, though, Paul, is we have you to thank for Ron Hetrick. We had him on last week, our favorite little labor economist who used to run BLS. And that's how you and I started talking was, I think I must have seen you post something on LinkedIn. And then I called you. We were talking about that. And you said you have to know Ron. And then God bless him. Anyway, so he's been on our show twice. He has actually explained why the discrepancies in those job report numbers. So I'm
Okay.
less cranky about it these days than I was before. So that's good. Yeah.
Yeah,
Thank
perfect.
you.
Yeah,
Thank you.
you're welcome.
Okay. Also of note, just need to say happy birthday to you. Happy birthday to you. Happy birthday, dear
Yeah,
Kevin.
Ben,
Happy birthday to you and
and
many
many
more.
more.
We won't discuss your age
So
because
many
it's
more.
not young anymore.
Okay,
Happy
so
birthday, Kevin.
I did that same thing in the preview.
Yeah, he did. Paul,
Yeah,
well, I mean,
I got it twice now.
maybe we call that singing. I don't know. So so, Paul, I just want you to know that if we run out of things to talk about, I can have people weigh on whether I should still have a two-hole punch in my drawer.
Oh,
This
geez.
Oh,
this
yeah,
was a
that's the big thing. Two hole
it
punch.
was a this was a conversation recently, and I for some reason I may need some therapy to let it go. It's just such a
So if
fixture,
you have a
but
two-hole punch binder, that is really, I
I
mean,
don't.
who's,
I
oh,
have
okay.
I have no ACO fasteners. I have no reason to have it. It's really becoming clear, but anyway, it's one of
The
those
two
relics
hole
from
is
the
at the
past.
top, and the two hole is at the top, and the three hole is at the side. So there's that.
Okay, I'm keeping my three-hole punch, but I might let go of that two-hole punch. All right.
The three hole punch, I know there's still some use for that because
Yeah.
there's three ring binders. But the
All
two,
right.
and then the thing about you really want to tell a seasoned loan officer versus a newbie, you ask them about stacking order in a file.
I
Yeah.
miss stacking order. It made so much sense. You knew where to find everything. Now I go into the e-folder. I have no idea where the hell anything is. It's like a disaster. Okay.
Well, I was gonna say what I do with my files personally when clients give me their files, I actually classify them in the same stacking order. So I do income, assets, um, property, all the same thing I would have done if I was stacking them, and I just classify in my files that way. So it's a lot easier to find the files.
Every time we
Kevin,
talk
happy
about
birthday. Can I recruit you? Jesus, that's
someone said
unique.
that.
Yeah, right. So nobody. Okay. So the processor or somebody, right, organizes all of that in the world that I review and operate in, and so clearly, Kevin, if you are that loan originator, everybody loves you. So that's why you're gonna have a
No,
good.
no, my
That's why you're
processor.
gonna have a good birthday because everybody loves you.
Kevin,
And Audrey, I don't know what your style is. If you're not doing that same thing in your stacking order, shame on you.
well, I'm a former processor. That's how I started in the business. So I was the anal retentive freak who used to do everything meticulously, not just for, yeah. But it's interesting because Kevin he does not get credit for what he does on his files at all. And he should, because I literally I got to the point and it took years. I mean, I was writing a cover letter for every submission, and the processors and all the AEs are like, "Don't do that. Why are you doing that?" Anyway, so yeah, we've had a whole flipsy. So Lilia says, I still upload my files in the same stacking order as I used to. I mean, it makes sense, right? Anyway, all right, moving right along. I just want to, I know I have been beating this drum, but I don't think you can beat it enough. Okay, that somehow doesn't sound right, but you get my drift, right? Okay, cybersecurity. We need to really be vigilant because Scott Bessent, our Treasury Secretary, came out yet again saying that AI driven bank account hacks are happening or could potentially happen. Anthropic's AI model that we've been talking about, and I don't know how to say this either, this and Paul's last name, Mythos, I think is the name of the program. Anyway, that program is able to get around all sorts of security, and they're really concerned about bad actors getting in. So pay attention to your bank accounts and what's going on with that, and then also make sure that we are checking our systems. Don't let this go, because I know that, all of a sudden I blink and another 5 months have gone by. Put it at the top of your to-do list. Make sure that your systems are secure. We have an obligation to our borrowers to make sure we're protecting our clients' private information and all their information. So be really careful. Even then, it might not be enough. And just one more time, anyone, analog, fax machines, anyone?
Gold, gold.
Okay.
Gold,
Dig a hole
gold.
in the yard, put gold in it.
That's right.
So,
We could,
so I want to get a little granular on that for just a second from a practical application standpoint. So the early warning, and look, there are certain times of the month, right, month end especially, right before the rescission period, you're busy and your systems are strained. So that period we're not gonna talk about. But if you have a strain on your system before, throughout the month, and it's just dragging and dragging and dragging, and your IT is not explaining it to you, that's the first sign that there's something going on.
Hmm.
And
well, then
then
that means Encompass is always being
no,
attacked because
well,
it's so
well,
slow.
outside of the norm,
Okay.
outside of the norm. And so for all these companies, and look, it's a dirty little secret because nobody really talks about whether they've, now there's some rules around the reporting of it, right?
Yep.
But in the end, nobody really talks about the details of what they had to do, how they handled it, blah, 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 and all of that sort of stuff. But at the end of the day, I think that, if you're on the operating systems, you're the first line of defense. You
Hmm.
see what's happening, and if it's something out of the ordinary, I think you just pick up the phone or send a message or a DM or whatever you're doing, and let people know and let them look at it.
Yes.
And I'm sure that all of us have great relationships with our IT people, and they love hearing from us. So that's a good way around that kind of situation.
Okay, so Paul, let's just back up for a second and explain who you are. I'm just going to say that I met Paul on LinkedIn because he is extremely prolific, and he has a really interesting wide range of experiences and background and in and out of the mortgage space. And so he and I became connected because of that. And so he has a different take on some of these things, but also you have clients who have been hacked and held ransom, and you're aware of this. So he has a unique insight into that. And I was telling you earlier that we've had the FBI on and we've done a number of cybersecurity shows, and it is brutal. The what, Kevin, do you remember what the percentage of businesses that go out of business once they have had some sort of cyber event? It was huge. It was like 60% or something like that, right?
A lot too. The other one I remember though was if you pay the ransom, maybe only 20% of those actually you get your stuff back.
Yeah, you hope you get a good bad guy, because
Yeah.
if you
Well,
get a bad guy, they just take your money. You never hear from them again. If you get a good one, they take your money and then you get your information back or your
well,
systems back.
your technology does like a reset, and then you have to, sort of recapture and reinvent all the stuff that happened after that reset. And then if they don't really detach from you, it happens again.
Yeah.
Obviously, it's one of the biggest that I, sort of. And look, does it mean that Academy went out of business or sold to Guild because of the $43 million that they had to pay? I don't know. At the end of the day,
Do you hear
there are
that
some
number?
there's some big numbers, right? Huge
Crazy.
numbers and big companies, right? So I feel and I don't want to pick out, but when I have clients that have called me up and said, Paul, can you put me in touch with somebody that already experienced this so that we can learn from what they did and how they handled it, and at least from their point of view. Now, granted, the legal relationship around all that and the sharing of information, I'm sure that they're highly guarded. But I think, benchmarking those kinds of things, if somebody has gone through that experience, the industry helps the industry. The industry wants to step up and say, hey, don't do this, do this. So,
Yeah.
I don't want to belabor that issue. And I think it is it's nuanced to the degree that I believe it's going to be more, not less, because of AI, as you alluded to, Audery, and uh, and so all of us have to pay attention. But the IT departments are acutely aware of it, and I think that when people get fired because they didn't protect their company, and they sort of I don't know, there's lots of fallout that happens. It's a shame that we're at that point, and I'll just give you for instance. I own a company. I pay cyber insurance. My cyber insurance, if I told you how much it has gone up in the last decade, I mean, I don't even want to admit it publicly. And I'm a small company, right? So it's frightening, and it's limited coverage. So if you have an experience, right, and I don't want to beat this issue to death, but if you have an experience, you will not get one provider for your cyber insurance in the future. You have to have it shared. It's sort of like owning a home in Florida that's, a million
Mm,
dollar house in Florida, and you have to have two or three different insurance companies because they don't want the
right.
liability. Anyway, we beat it to
Oh,
death. We're moving on, right?
All right, moving on. All right. So I try to save something good for the end, but I'm just going to hit you with it now. Totality. We recently had Dr. Selma Hepp on. She's one of our favorites. And she was talking about how they were revamping their modeling. And so they just came out with March home price insights. That's their home price appreciation report. And we were up 4/10 month over month, which is great. If you annualize that, it's like 5% a year. And they are projecting into the future. And again, this is what she was talking about. They were adjusting their modeling a little bit, 5.1% for the next year. And so it'll be interesting because God knows there's a lot going on, and who knows what tomorrow will bring, or I don't know, 30 minutes from now. But we keep our eye on the ball, and we keep helping people get into homes, and we keep helping them solve their problems that they have in their world. And all this noise is a lot, but anyway, so I thought that was good news. We still have positive growth, not crazy, not out of control, and that's nationally, we know. So it varies region of region, but there you go. New home sales, those were up big time February and March. So February, yeah, rates were down. That was to be expected. We were up 9%. March up 7%, even with the rates up. And that was better than they were thinking it was going to be. So how about that for some good news?
yeah, I can't
That's
remember.
wonderful.
Do we talk about my deal last week that the asking price is $1.6 million?
Oh, no, we did not. Tell them.
All right, Paul. Condo, San Francisco, right kind of in the heart of the city. It's an older building, 1930s style, but renovated nicely. Top floor of a 3-unit building. Um, Asking price 1.6 for a 2-bedroom, 1-bath. What do you think the place sold for?
Um,
Just
Think
quick,
one,
big,
no- one,
Paul.
one, one nine.
how about 2.4?
Geez,
That's a
over
50% over,
1.6.
50% over the asking price.
Yeah.
Oh, geez.
Yeah. I have
So
clients
for
right now, they're on their fourth offer in 2 weeks. They're bidding hundreds of thousands of dollars over, and they are getting beat out at every turn. And I keep begging the realtor to please let me talk to the listing agent. So far, she has not taken me up on
so,
that. But I'm like, it is wild. And then you'll see some places that just sit there. So it is a wild, weird market out
Okay,
Mhm.
there.
so AI may be doing some of that as well, because these are folks that are getting rich off of AI, obviously.
Yeah,
So
they
Who?
are.
Not obviously. No, as a matter of fact, no, they're not. My clients
These are
are.
not tech. These are not tech remote
No, nope,
folks.
nope,
Really?
nope. How about yours, Kevin?
Um, I did have a tech guy doing AI.
Nope, that one. Was it that one?
Not that one.
See?
No, no. In
Crypto.
fact, I have another client right now in the contract. He's a garbage man. I mean, they're just
It's all over the place, man. I'll tell you, and it is not just the tech people.
Mhm.
It is crazyville out there. So yeah, something
Well,
else.
the good news is the home price appreciation, although geographically there are pockets, right, where
Big time.
that's oversaturated and prices have fallen. But at the end of the day, obviously San Francisco has come back big time. Good for you guys. Good for the California market. I think that you know, with all of the commercial real estate that they said would bust up
Yeah.
and remote work and those kinds of things. Obviously, we've recovered from that, so it's a good thing.
Yeah.
My office rent keeps going up. I called my commercial client and I'm like, is that for real? Like, is that really a thing? I mean, should I tell him to bugger off or not? And he goes, yeah, it's a thing. Can you believe that? So, okay, so Peter is saying how many of the offers at the higher price are closing at the accepted price versus getting negotiated down after inspections once the competition is gone. And I would say that when you have multiple offers like that, you've got people in like in the
There were
wings.
four offers over 2 million on that
Yeah,
one.
yeah. So
Yeah,
you yeah, the
so
sellers have
you have
options.
waited in line,
Yeah,
right?
It's
yeah,
There,
something.
yeah. You get your backups. You
yeah.
might take a smaller backup. You may.
So I ask you guys a question. So obviously California had the fires, right? And a
We
lot
put
No,
of
them
those.
all out though,
nope.
just for the
We've
record.
never
Yeah.
had a fire, Paul. What are you talking about?
We put all those fires out. There's no fires right now.
Yeah,
Okay,
it's
but the
rainy.
point,
We have
It's rainy,
the
Paul.
okay, I know, I get it,
We don't
I
like
get it.
talking
All this,
about this.
okay, I get it, but some of those areas, right? Some of those areas, how's the value performing, right?
Mhm.
Same logic,
You mean
same.
for the houses that are still standing? They they come back. And you know what's
I'm
interesting
not
is
talking
those
about Southern California. I'm talking about the wine country, for
well,
instance, right? That's close
so
to you guys.
it is. So it depends, but I mean in general they just come back. I mean people want to live there. And actually, once a place has been ravaged by fire, it's actually doesn't catch on fire again, really. It's actually a really safe place to live after that because there's nothing left to burn. So everything that's built is built to new fire standards. There's no more trees. I mean, what is there? It's fine. Anyway, let's move it
Okay.
along, shall we?
All right, Audrey.
Actually, it's interesting you bring that up though, about California, because I always thought, oh my God, how many disasters hit California? But I just saw the natural disasters map, and it literally seems to cut off like the Rocky Mountains east, all these natural disasters, and then
Yes.
west, not a whole lot. And yet,
Yes.
we keep hearing about, oh, California, we've got
Yes.
earthquakes, we've got fires, we've got,
Well, like
flooding.
Okay,
certain
so
Oklahoma.
North Carolina has earthquakes. I've experienced that. North Carolina has obviously tornadoes, and we have we just had half of the state in the West, basically under flood disaster, right? That was a disaster out, west, and clearly, the government stepped in. They still haven't, that they still haven't recovered. So again, Audrey, moving on. I don't want to belabor those are not positive things to talk about.
I know. Let's talk about sunshine and rainbows. All right, but first let's talk about the Fed for a second. So Jerome Powell had his last press conference last week at the end of the last Fed meeting. Obviously, well, not obviously necessarily anymore, but rates stayed the same. And he announced that he's going to stay on until he is sure that the DOJ is really, really done with him. I don't blame him, honestly. And I have to say, I listened to somebody talk about what he had said, and then I listened to the entire. I mean, I always listen to the entire after the meeting speech, his comments,
Yeah.
and he was very, very measured, very diplomatic. He was very complimentary and supportive of the incoming Fed chair, assuming he's going to get confirmed. So I thought that he handled it beautifully, and somebody else's take on it was very negative, and I didn't.
Wait.
I wondered, are we listening to the same press conference? It was interesting.
I have found that so many times when I listen to like a actual speech, and then I
Yes.
read the news reports. I'm like, wait, did they listen to the same report that
Yes.
I listened to? Because this is a total different take on this.
Totally
And
crazy.
that's why you need to listen to all sources for news because,
Yes.
like you said,
Yes. Do not take someone's word for us, except for ours, because we just give it to you straight, baby.
there we go.
So I'm a Fed watcher all the way back to Alan Greenspan. As a matter of
Oh,
fact, behind me, I was just talking about a book, The Age of Turbulence. Alan Greenspan, I think that was his. I mean, he's probably written a book or two after that, but that was his explanation for things and decisions that he made that he got wrong. And so it was an admission that he got some things wrong. And I can remember, as far as transparency is concerned, that everybody needed a translator to understand Greenspan because he talked in such jargon for the industry that nobody really understood him. And Kevin is coming out and he's saying, I'm going to be, not as vocal as Powell. And
Warsh, not to be
I,
confused with Casey.
yeah, so anyway, Powell for me, and I've watched most of his press conferences. He is the most consistent Fed chair we've ever had as far as his messaging is concerned. I don't think that now was it the message that anybody wanted to hear? Probably not. Was the transitory comment a tragic mistake and will that attach to his legacy? Sure, it's going to. But the needle will not move rates because our nation's debt is going to solidify what happens to
Uh-huh.
rates.
Yep.
And clearly, we're not going to see if we see and for all those folks that are going to watch this and you guys as well, if we see rates in the fours, high fours or low fives in 26 or 27, I just don't think that's possible. So
No,
It
God,
would,
no.
it would
I'd be
have to
happy
be
to see it in the high fives again, for God's sake.
it
yeah,
would have to be something just catastrophic.
Yeah,
catastrophic. That's
please
right,
don't
Kevin.
wish
And
for
we don't
that.
want catastrophic.
That's right. It's your birthday, so we need to talk about stuff that is positive. But I think that at the end of the day, for all those folks that are waiting for much lower rates, please stop waiting. Just
Oh,
just
yeah, no kidding.
reinvent yourself, pivot, do whatever you
I
have to do,
had
and just get over it.
I had a
Yeah.
client yesterday, and she was talking about whether she do a 5-1 arm or a 30-year fix. And I'm like, I'm not even going to offer you a 5-1 arm because I don't think it's a smart move. Because if you're planning on holding that house for more than 5 years, then you could get caught 5 years from now or 7 if you take the 7-1 arm, where rates are going to be much worse than they are today. And
Could be.
you could be. I said
Could
could
be.
be. I did say could
You
be.
just said are going to be.
No, I said could be. And if rates could be higher than they are today, you can't go back and get that 30-year fix you can get today. But if you take the 30-year fix and rates go down, you can refinance and grab that lower rate later on.
I agree with all that, Kevin, and certainly it's always the better of. You if you're going to pay, you can get something lower, but it's going to depend on what
Yeah.
your particular circumstance. It's all situational and very personal, and
Mhm.
so folks, you guys are originators, and a lot of your, I mean, Audery, I think you said a lot of your audience are originators, and and at the end of the day, your borrower, yeah, they want to hear about the rate because that's what they know, that's what they hear, right? It's plastered everywhere, but there's so much more to their personal situation and their financials, coming into light, their, how old they are, whatever their plan is for their life and their retirement and all those kinds of things, or they're starting out, first time home buyer, all those moving parts. It's complicated, but I always advise folks that it's a snapshot in time, and it isn't, you're not locked into 30 years, although it's a 30-year, conventional mortgage, right? You're just not locked in. And I think that the difference between sort of the coastal versus the middle of the country, people in rural areas do lock themselves in and they don't think about it anymore,
Yep.
Yep.
right? They just
Yes.
don't they just don't
Yep.
want to think about it anymore. And the folks in the urban areas are a little bit more transactional and thinking about the financial component of that. What can my house and my equity do for me financially? And they use it as that financial instrument. So there's so many different situations and moving parts. I'll just say that, you spend time getting to know your borrower, you're going to know their situation. And they're going to appreciate that you took the time and the interest to do that.
So Fannie and Freddie came out with their first quarter earnings.
Mhm.
Kevin knows, probably anyone who listens remembers, it makes me so cranky every time I see these. That's right, kids. 3.7 billion in Q1 for Fannie and 3.6 billion for Freddie. And Freddie is catching up. Remember when they used to be kind of the laggard? They were way behind Fannie as far as volume and they just weren't doing as much. Well, apparently they have fixed that. But I'm like, okay, who else is making money like this right now? Who, Paul? For God's sake.
So So I would just say that are we going to, I mean, Fannie and Freddie, are they going to ever, be released and
And
right?
do we want them to be released? Is that
That's
really
right.
a good idea?
So that's the question. Do they
Yeah, that
have,
is the
I mean,
question.
do they have the capital and and can they really, I don't even think that, when they said that they were going to do the 200 billion, I thought, oh geez, can they really do that kind of thing? But at the end of the day, the income is undeniable, right? The income that's generated is undeniable. They've done
Yep,
extremely well.
yep,
And and also sort of the guarantee that they give, right?
yep.
Um, that's pretty.
It's
if you count,
important.
it's very important. If you count that and measure it against the non-QM margin calls that we saw just a few years ago, where
I
non-QM was
I know.
decimated overnight,
Yes, I
then
know.
then we need the backstop of the government, right? So I feel that I want it to sort of be not privatized to the degree um, that that it performs well and it should be that guarantee for the mortgage market. But it comes with a lot of strings attached and a lot of conditions, and therefore it sort of is what it is. That's
So
my thing.
if their press release is to be believed, and I would think it is, Fannie's worth 112.7 billion. That was billion, and Freddie looks like they're worth about 74 billion. So they're doing all right, Paul. And I agree. It was interesting because I was sort of wavering before COVID, before the CARES Act about, do we really need them? Is it really that important? And then to your point, non-QM went away, Jumbo went away overnight, and then they were all we had. And that was a lifesaver for sure. But again, like, yeah, don't even, when we talk about affordability, when we talk about rates, when we talk about how do we free up the market a little bit, those LOPAs are clearly working for them. And do they need that much? When is enough enough? That's my question always, not just to them, but to the industry as a whole. When is enough enough? So, yeah, that's,
If
yeah.
they're the only, okay, so if literally the GSEs are the only one making money, and sometimes they are, right?
When aren't
Um,
they recently? I mean, when was the last time they didn't have a monster quarterly earnings? When? I
well, it
don't
was structured.
remember.
Well, it was structured that way, right?
Yeah, yeah, yeah,
Calabria did that.
yeah, yeah.
So,
But
and look, I
again,
don't, I don't want to belabor the GSEs, and I don't want to pick on them because they're an end game that's necessary, and it's not. I don't want it to go away,
I
and
don't either. I just want them to, I would like them to make some adjustments to the pricing so that it isn't so expensive for the borrower. That's what I would like. When they clearly are making more than a healthy profit, and maybe they could pass some of that and have it turn into savings for the borrower. That's all.
and Audrey,
That's all I want.
I would just counter that. They would tell you that look, if we were putting the squeeze on the borrower, we would have a lot more defaults, and
Wait, say that again.
if we were putting the squeeze,
What does
the
that
financial
mean?
squeeze on the borrower, right? then
Oh, I see what you're saying.
then we would have, right, a situation where there would be a whole lot more loan mods. There would be a whole lot more, distressed borrowers. And look, there it has increased from the baseline of nothing, right? So
Yes.
at defaults, they were calculated differently, and now they've taken that away. So if you look at defaults were up, but now the calculation has changed back to what it was originally, and defaults should be back more in line with the trend. But at
But
the end of the
they're
day, I
still
think
lower than historic
Still much more.
norms for
Yeah.
that's
sure.
right. That's right. That
That's
that's
right.
my point. So
Yep.
so at the end of the day, when you're judging performance, I think it's judging performance. That's how they justify the economic condition that they're in, because it was always an end game for them to be private again under this administration.
I know all that,
Yeah.
but return to my original point, which is they could charge less and still make a profit and still be
Actually,
solid.
as a company, what do they say? They're worth $1 billion each.
112.7 billion, Kev.
112.7 billion. And how much do they make in profit?
3.7 in the first quarter.
3.7 million or billion?
Billion.
Billion. It's
Billion.
billion. Yeah.
That's
Hilarious.
about 25% return on their money. That's pretty good. Yeah.
Yeah, that's okay. So, according to Fannie, and again, I believe them here, our foreclosure prevention solutions allowed more than 24,000 homeowners to remain in their homes. So they still, even though there have been some tweaks to the modifications in that whole process, that they're still helping people stay in their homes, which I support, actually. I'm not a big fan of just sock it to them the second that they're having an issue. See if there's some way to help someone stay in their home, not like the perpetual churning of modifications or bailout solutions, but but just in general, give it a shot first.
So my company Grid, right, originally was a loan modification company. And
Oh,
so we are still on we broke it apart. There's two companies now. And so that partnership, back when Fannie and Freddie were doing all those loan mods, there was a system called SMDU, and that's just a software system, and so you signed up to be a part of that. You invested a lot of capital, and then you did a lot of loan mods. Well, loan mods haven't really gone away. That business, I mean, I see the results all the time because I'm, still involved with that, and at the end of the day, we do have a condition where the borrower, if they state their case and they are really, in the shape of a loan mod, and they can, qualify for that, those programs are still doing what they intended to do. So defaults and foreclosures, you put a home on, if a home goes into foreclosure today, for God's sakes, you got it's sold immediately, right?
Yeah.
I mean,
Yeah.
clearly. So inventory, it goes back to the inventory issue, and I think that cycle is just a much better cycle than it ever has been historically,
yeah,
right? I'm just going to say that, and then
I agree.
and we beat it to death, but it really is a much better cycle than it ever has been.
I agree 100%. Actually, you know what? This was a question I had recently and I looked it up. So I wondered how mortgage loans in forbearance were reported to the credit bureau and whether they showed as delinquent or if they showed as current, or how do they show up there, right? So apparently,
Great question.
right?
Yeah.
Okay, so apparently what happens is the count status is frozen at wherever it was when the forbearance began. So if you're current, it stays current. So they might have a deferred payment code on it, but the forbearance actually doesn't show as a negative item. So I thought that was really, really interesting. Some lenders might still say no forbearance, and it might be visible in the future to someone pulling the credit, but it doesn't actually directly hurt the credit score. So anyway, I
Well,
thought
it
that
hurts
was
it hurts the servicers. So
I'm
all of that
yeah,
stuff,
no, we're not
all that
talking about the service,
all,
just
all
the
that
score.
all that stuff that you have just described is tranched out.
Yes.
Each one of those tranches gets a score from a servicing standpoint, and the servicing company has to explain all that, right?
Well, it is, but what I'm saying is on the borrower's credit report, That's what
Hmm.
I'm talking about.
Got
And
it.
I mean, the whole, as far as the servicer goes, that was really one of the weak points of the CARES Act was nobody thought through what what they did to the servicers when they let everyone go into forbearance overnight. So that was a whole nother thing. Whoopsie. I mean, they worked it out in the end, but holy
Fair
moly.
enough.
And Elena is saying it's on the mortgage statement. And again, it might show up somewhere, but apparently it doesn't show as a delinquency, and it doesn't report as it doesn't impact their scores. That is what I learned. So if somebody knows something with a better source than I had, then let me
So
know. But
people should take advantage of it then.
okay, so let's talk about, oh, shut up. That's ridiculous. Okay. So
You guys.
okay.
I'm
So
gonna call my
let's
servicer right now and see what I can do.
Oh my God, unbelievable. What are you going to tell him? It's my birthday.
It's
I don't
his,
want to make my
that's
mortgage
It's
right.
my
It's his
payment.
birthday.
birthday.
I
I was
can't
gonna,
make a payment today. Can you push that off for a few more years? Yeah, they'll do that. You just have to
Yeah,
ask twice.
I
that's
was
a
gonna do
great
that
idea.
exact same thing. It's his birthday. Give him a modification, right? So,
We give such great advice on this show. It's great. Okay. So I want to talk for a minute about credit because we have this big announcement, the rollout with Vantage and FICO 10T. And I thought it was interesting because Fannie and Freddie were opposed to this, yet FHFA decided to go ahead with it. And then also I've heard this conversation about how lenders are worried that people are going to cherry pick which model has the best score, and it might not reflect the borrower's credit worthiness. And then of course we have the secondary market. That's a whole big, my gigantic ocean of uncertainty, so they have no idea. And so we don't have a record with Vantage. Apparently the pricing is going to be crappier for Vantage score than for the regular FICO. I mean, yeah, 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 yeah. So
okay. So,
and then also let's just hang on, let's just throw it in there. Also, never forget the Vantage is owned by the three bureaus. So I mean, not that there could be a conflict of interest or anything, but it's gonna be quite the adventure rolling all this out, don't you think?
okay. So I've debated and I've posted about this, and
Why I brought it up, Paul.
clearly, right? So there's there's the folks that a quick look at their credit, right? And that's very cheap. You trust that they are who they are and they do what they do for their income and all is good. And then you go down the tranche and it gets complicated because you're looking at it, you're going to look at it again and again and again. And sometimes you look at it so much it's 400 or 500 bucks.
Oh, you mean
And
the credit?
oh yeah, just pulling credits 400 or 500
Yep.
bucks.
Yep.
Yep.
Yeah, we
And so
know.
yeah, so at the end of the day, all of these nice 99 cents here and this you get this right, all that smoke and mirrors for
No
the
kidding.
complicated deals. So complexity costs more, and that's what it boils down to.
Uncertainty
And
also costs more. That's what you're
yes,
paying for there is the uncertainty of is this model going to reflect the credit worthiness of this borrower? And since we don't know, we're going to charge you more.
and your investor, well, because the investor really is wanting to understand those dynamics. And look, I feel like AI, getting back to AI, does Fannie and Freddie really need to have outside help with this? They have more data on people. They could actually do a credit score themselves, right? I mean, they could really come up with a credit score themselves. They don't really need all these vendors to do that kind of thing. And he who holds the data holds the kings to the kingdom here. And so I think in just a few short years, even though I do want the competition and I get the Vantage score and all of that and one monopoly trading for another monopoly and they're all sort of it just sounds collusive to the degree. I don't want to say collusive and imply that's my it just on appearance.
I mean,
Um, but
theoretically, it could be.
day, at the end of the day, you pay what you pay for the risk you take on the borrower. It's situational, and you're going to pay more if you're uncertain, right?
Yep. Yeah.
And so that's the way that it works. And I think from a data standpoint, this data is going to be available someplace else. And as Kobe Hakalar
Yes.
had just said recently, we need 10 competitors doing this, right? I don't know that we necessarily need 10 different companies trying to spend capital to have access to Fannie and Freddie or FHA, because you do have to spend your capital for that integration to be able to do these kinds of things. But I think that the story isn't over. It's not over with Vantage. It's all of these things are just the beginning.
Yep.
And I think that we are in for a rapid evolution of all credit.
Oh, hang on. That's a statement right there. A rapid evolution of all
Yeah,
credit. Let's
Yes.
yeah, that
unpack that
makes
for a
sense.
minute, shall we? What the hell
Why
does
do we
that
need to
mean?
run credit on someone who's got paying their Fannie Mae loan for the last 15 years, never made a late payment? We shouldn't even have to run credit on them. They should be just good to go.
It's an instantaneous pass, isn't it, Kevin?
Yeah.
Yeah,
Right?
yeah.
I think that scenario should exist.
Well, I think that on a rate and term refinance, all you should have to do is fog up a mirror, prove that you're actually you, and then move it along. Because, I mean, again, they already have the loan, so and they already have whatever the risk is. If you're lowering the interest rate and the payment, the risk goes down. I mean,
Yep.
in theory. So
And
why
you're
not?
extending the term out over longer, so hey, it's even lower payment. So
It's all about consumer behavior, and again, back to who holds the data. The GSEs have, and the government has tremendous data here. So at the end of the day, um, I feel like the competition has just started, and we're relying on, you know, tenured experts because they've just been doing it the longest and they're so-called trusted the most. But if we talk about cyber attacks, the credit agencies aren't exactly clean of cyber attacks, right? And
Nope.
customer information and all that privacy concern, right?
Right.
So, and my take is, again, it's in its infancy and the evolution is going to be on steroids. We're going to see a lot of change happening very quickly.
hey,
So, okay. So actually, so Kevin,
yeah.
so I don't know if people realize how organized we are about things like, oh, I don't know, the title of our shows. So this is how this goes down. Kevin puts together a flyer. He comes up with some sort of title. It may or may not be based on anything. I kind of do the same thing on the Zoom side. So he's doing our flyer side. I'm doing the Zoom side with no consultation usually between the two of us. And so today, because you put on the flyer, I happened to catch this. I'm like, oh God, we should probably talk about this since it was literally the title. How will AI impact mortgages? I was laughing so hard. I'm like, oh God, we're going to go through this whole thing and forget to actually mention that. And it was the title. So, Paul Hindman, AI and mortgage. It's a huge topic, as we know. Although you and I are on LinkedIn, I mean, you are providing content. I am merely reading. And for some reason, all I get is mortgages and AI. And so I've got all sorts of interesting folks popping up. Plus, I have a kid in AI, and so he's in the middle of it in San Francisco, and so I get that part of it too. So we know that AI, the data centers, all that was 4% of GDP last year. That's a huge part of what uh, the economy is producing at this point, or I don't even know if producing is the right word, probably not. Anyway, we know it's a big deal. We know that a lot of companies are using it as an excuse for laying people off and saying, oh, productivity, blah, blah, blah. But then we see this whole other side of the conversation. I'm guessing you see it too. I don't know what your algorithm is popping into your feed, but there is a lot of conversation now about how the people who laid off a lot of employees are now having to rehire them, and that it is not what it was said it would be. How does that all translate into the mortgage industry? Because we've seen people kind of head towards these models and then back off
Okay.
from them, and
Yeah.
yeah, so talk us through what you're seeing.
I'll keep it simple, right? If any of this
Impressive
can,
if you can.
if any of this can be really simple.
Right.
So you have technology that the development cost a fortune. So to deploy it And you guys think about all the technologies that have been rolled out over the last 10 years, right? And then you talk about that stacking order that we started with. Is that stacking order changed? Has the number of documents really changed? Has the process really changed? Is the cost per loan really lower? I would tell you that with all of that innovation that we spent a fortune on, it didn't really change those numbers at all.
Yep.
And look, the loan size got bigger, the commission got bigger with the loan size. That's a good thing for folks that are paid on a tiered commission given the size of the loan, right? Jumbos are now capped, right? The caps are a lot less. I can remember when jumbo caps were, 15 grand, and now they're less than 10 most of the time. But having said that, the economics have all shifted and become very, very precise and precisioned, but technology still eats up and gobbles up a huge amount of capital, right? And until we see AI lower the capital expense for any of those technology efforts, which hasn't really happened. Now, a lot of companies will claim, oh, yeah, I'm saving this and I'm saving that. And your point for hiring the resource back, if it's so expensive to maintain the technology and then you put yourself at risk from a cyber risk standpoint, wasn't it better to have a human do it?
I think that needs to become more and more of a question, which is, and there's a guy on LinkedIn, I'll probably say his name wrong too, but Stephen Klein, who teaches at UC Berkeley, and he is often talking about how AI and all this technology should augment what humans are doing, not replace them, because you lose this whole component of humanness that we bring to the process that cannot, even though people say it cannot be replaced by a computer. I mean, we talked about this over the last few months, especially. Kevin and I spoke at an event a few months ago, and it was a room of what, 150, 200 people, something like that. And we asked the room, are any of you doing deals right now that did not require like human hand holding? Because they are tough deals right now. And the answer across the board from AEs to LOs to company owners to brokers was no, because these deals are not simple. So even
Yeah.
if you
Okay.
have a W 2 employee with a pay stub and they're buying a house, so in theory, the loan, the qualification part is easy, supposedly. But what's not easy is what happens when the HOA doesn't get approved on the condo and they are freaking out. Is the computer going to comfort them? What
I
happens?
I I I love underwriters because underwriters are the first line of defense for the industry and always have been. And at the height of, COVID and remote work and interest rates that were, 2%, um, you know, you couldn't find an underwriter and you couldn't pay them enough. I knew underwriters that made $200,000, right? So, um, now, granted, that's not the world we live in today, but there's a lot of companies out there that claim that they can write a program that understands all the nuanced behavior of the borrower to the degree that they can figure out that product complexity. Because clearly, you guys have to satisfy switching products on a customer that does stuff that those dynamics change. Let's just take the borrower that goes out and buys something in the middle of getting a mortgage. Good grief, right? Why do they do that? People warn them all the time. Don't do that, but they do it anyway. So
Not everybody gets the message.
yes, so there's an underwriting complexity that AI just isn't nuanced enough to
Hmm.
address,
Yep.
right? And at the end of the day, again, back to why I love underwriters, because underwriters will look at what comes out of an engine and second guess the reality of whether that's correct. Now, a lot of companies will say, hell no, I don't even want the underwriter to look at it, right? Let's take it away from the underwriter, because if we don't take it away from the underwriter, then they're going to look at stuff and spend time, and that's going to cost me money that looking at something that the AI or the system has already determined. But I would tell you if the system was so clean, right? Why in the hell is there so much breakage? The system was so clean. If all the determination for these systems and the outcome of what they're doing is so clean, why is there so much breakage in the borrower experience? I mean, only 1 in 5 borrowers go back to the original loan
Yeah.
officer, right?
Yep.
So if it was as sophisticated as the human element, which I just don't think it is, and I don't think it ever will be.
Right.
But look, I'm going to be dead before all this stuff is figured out. But at the end of the day, it's in its infancy still. A lot of people say that's not true, but I think that it is. And if it's a compliment to someone and their human experience, I'm all for it. If you want AI to write an email or write what you say every day or whatever, fine, do that. But
Right.
if AI is a better you than you can be, good on that, right? But I don't
If A
personally think it's possible.
if AI is a better you than you should be, then you should take a hard look at yourself and fix that because there's something very wrong. Holy schmoly.
That's right.
Okay, so you talk to LOs all over the country. So what would you suggest an LO do in May, for God's sake, of 2026 to be relevant, to stay relevant, and to stay positive and focused on what do we do? Help people. We help people. We solve problems. That's what we do. But it's hard to do that when you're, like in this environment. So, what are your suggestions? What are you seeing successful LOs do?
I think that the LO's first job is to listen to what the borrower is looking for and then determine if they're looking for the right thing.
Right.
Right?
Yep.
And you can help them navigate that because a borrower sometimes doesn't know what's out there and how to look for it.
Yep.
And so if you can help them because look, they go shopping on the internet and all the different platforms and just like anybody else, they want to buy and see and look at something that they really probably can't afford. It's wishful thinking. And the LO's job isn't trying to tell somebody, hey, look, I want to step right on your dream. No, but I want to understand your situation and I want to understand your financial situation even more because I got to talk about affordability for you. And
Yep.
that's affordability right now. And affordability is a snapshot in time. And here's what you can do 5 years from now, right? If you stay on a plan and you can get to where you really want to be, but for right now, this is what's in front of you. And I think that if an LO just walks through that very practical dialogue with their borrower, they'll give the borrower an experience that they'll appreciate and they'll talk about and be thankful and grateful for. Because as soon as they get the keys to that home that they want or refining, um, at the end of the day, satisfaction and customer satisfaction, they're going to let you know because the first thing that they're going to let you know is if they're unhappy, but they're definitely going to let you know if you ask them at the end if they are happy. And I would hope that the happy is the biggest part and the unhappy is the smallest part.
They So when I get together with borrowers, I make sure that I scare the crap out of them. I threaten them. If you do this, I will kill you.
You know,
If you talk too much about interest rate and stop thinking about payment, you're in big trouble. Time out for you. Yeah, just
I think I was
violence
talking to
and
one of your
and
past
bullying.
clients.
What, Kevin?
I said, I think I was talking to one of your clients you were trying to bring in the door this week because I talked to this gal. She called me on Thursday last week. She had been referred to a realtor and kind of went through a scenario. And she was in a little bit of a hurtful situation where she needed some money pretty quickly and desperately. And I was super calm. And I said, no, no problem. I can take care of that. I'm thinking, just do a DSCR. It's on your rental property. It's easy peasy. And but she, instead of getting me the documents I asked for, picked up the phone because some other lender called her back on something. Yeah. And she fell into this rabbit trap of all these hard money lenders calling her. And she goes, they confused me so much, and they were yelling and screaming at me, telling me how much I sucked. My credit score is bad, blah, 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 blah. Her credit score is 680. I mean, yeah, 680 is not great, but it's not a terrible credit score. There's lots of stuff I could do for her. And I'm just, and she goes, you're like the nicest guy I've ever spoken to. Like, you're calm, you're easy, you're not worried about this. She goes, I'm definitely going to work with you. But the funny thing is, though, right before the show, I looked, she had loaded up her files. Did she send me everything I asked for? No. So
No.
we're going to have to do some hand holding.
Yeah.
Yeah, but Kevin,
But
what you
Audery,
did,
don't yell at your clients, okay?
what you did that's the most important thing though, is you listened and
Mm-hmm.
you acted after you listened. And I think that that's the biggest part. And a lot of borrowers, they can't even get a word in because the LO is right. I mean, the LO is rapid fire telling them what they need to do, and they just don't get to participate in their own home buying experience. And so, um, I say
Yep.
listen before you act, and I keep it. I'm a very practical person when it comes to this stuff, and it's the human experience, and people are going to know. You feel their pain, they're going to relate to you.
Yep.
And you act dictatorial and a know-it-all experience, and they're going to remember that you just were an asshole, and they don't want to work with you.
That's a technical mortgage term, just in case anyone's
Oh
confused
yeah.
by that word.
That's
Yeah.
right.
So
I said I wouldn't use bad language. Jeez,
listen, we do our
Audrey.
best, Paul, but occasionally it
We're
just
losing our religion.
happens. Just happens. Okay, so yeah, so I don't know if you Google my reviews, we'll find that I have yelled at no one. And in in fact the opposite. But I am firm with them and I do school them on listen, it's about the payment. It really is. It's about the payment. We've become fixated on rate, and that doesn't do you any good. We got to figure out, can you afford this thing?
That's right.
So it is, yeah, it's a thing. So, okay, so briefly, um, a cautionary tale about a lender or a person who has opened one company after another, gone sideways. You've worked for him, and he's back at it. So, just in the event that somebody accidentally could get recruited by him, could you just give us the ever so brief rundown?
Okay, so obviously we're talking about Michael Strauss. Are we
And
talking
what
about him?
company was that? What company was that, Paul? Don't
Okay,
act
so his last
confused. You know darn
okay,
well.
so his last company, his first company was American Home, and he walked away with 200 million bucks, I think, somewhere in that ballpark. And his CFO and a few other people, they didn't fare well. I don't think his CFO got to work in the industry again. But but at the end, and I know that guy, so I have to be careful here. And I like him very much, and he was sort of set up. Um, but anyway, so he resurrected as Sprout, and when he resurrected, some of my Lehman Brothers folks asked me if I would sort of join the new entity, and I said that I would um, after they had joined, right? Because these are people that I trusted, and they assured me Strauss had changed, and new day, and reinvented himself. And it was really non-QM, and it was a unique non-QM because it was a newbie kind of company, and they were doing some very interesting things, and they rolled out some great products, and uh, and the experience from it, and they grew very rapidly. I was there at the beginning, and they were doing less than 5 million a month, so that tells you how small it was, right? And so he went on to rapidly get up to 200 to 250 a month, and so he was really killing it. And then he hit the wall, just like a lot of other companies, when with the margin calls, and in 22, 20, yeah, late 22, and of course, it turned out that he wasn't and this is everything that I'm sharing is public. Anybody
Right.
can. It's
Right.
been covered. It's been
We're
covered
not
by the press.
disparaging anybody
Yes.
who
Yeah.
has not. Yeah.
Yeah. So at the end of the day, he did some really horrible things. And how does that fast forward to today, right? And I will tell you guys that I had one of his employees that was with him for the start to the finish, um, that said they were still trying to get their income reported correctly to the IRS.
That is crazy to me.
And that because the income wasn't reported correctly to the IRS, that impact this person is older and that impacted their Social Security. And and so if you just unwind that piece of it and then all the health care that wasn't, funded, 401k that wasn't funded, FICA, workers' comp, all of those things. That's freaking, it's just unconscionable, right? But at the end of the day, um, by way of getting a license in somebody else's name, he's resurrected, and 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 I guess will he be allowed? Will the regulators just look the other way? I don't know the answer to that, but at the end of the day, he's not the first. He won't be the last. There have been companies that mistreated people um, throughout my entire career of more than 30 years, and there are going to be companies in the future that do the exact same thing. How do you
Crazy.
avoid the Mike Strausses of the world? um do due diligence, right? It isn't necessarily what they tell you, it's what everybody around them can tell you that had the experience with them. So do your homework, build relationships, connect with people that have a
But
voice and know the experience, and protect yourself. So
go to the places that retain their loan officers.
yeah, that's
Not
right.
trust.
Yeah.
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 Yeah. Well, so Kevin, when Paul was looking you up and he said, has he really been with this company for what is it, 31, 37 years? What, not 37, but 31 years? And I'm like, uh-huh. Yeah. You find your people, if they're good people, you stick with them. Okay, so we have a comment from Michael. He said the four seasons are fire, flood, earthquake, and riot. I would just like to say that is so 2020. We don't have all those at the same time anymore.
Yeah.
So,
And Oregon's got us beat for the riots. They do it on a regular basis.
geez.
So,
Okay. Kevin just spent the weekend in Oregon, so it's all fresh.
I thought San Francisco was bad, but holy moly, Portland, that's a
Don't
different.
say San Francisco is bad. San Francisco's awesome.
They're fixing things up in San Francisco.
It
Portland's
is,
going
yes.
the wrong way.
I mean, the Tenderloin was always a disaster. That's not going to
Oh,
change,
yeah,
but the
yeah.
rest of
No,
it's
but
great. Okay.
these are the good
So,
neighborhoods in Portland are bad.
okay, don't,
Well,
that's going too far. Okay. So Peter said, I wish the three of you were representative of the entire industry, or our reputation would be better. That is a very nice comment, Peter.
oh
So,
geez.
yeah,
Yeah.
on that note, that was a quick one, Paul. So thank you so much for joining us. Remember that we are here to help people. That is the objective. It's not what the bigger companies are saying, where it's all about volume and growth and making money. And it's about helping people achieve homeownership. That's what we do. So go do that. Go
Thank
find a loan. They're out there. Yeah, they're hard. We know, but they can happen. They can get closed if you work at it. And Paul, we really appreciate your input
Thank
today.
you.
So
Thank you
thank
so
you.
much for inviting me on. Kevin, have a good birthday. And for
Thank
all
you.
those listeners out there, I hope you found it. I said something valuable and interesting, and you can always connect with me on LinkedIn. Thanks so much.
All right. Thanks, guys. Have a great week. Bye.